Okay, traders, now we get into a very popular topic, one that's discussed a lot, and that is the topic of gaps. And there's a lot of good information about gaps out there already, and yet I find that when I talk to traders, they still are very limited in their understanding of gaps. So it's good to review and go over this. It'll be review for some of you, and for others of you it might be brand new information. For some of you, half and half. But anyway, this is really good information. It's important information because gaps are one of those things that everybody notices. So just like we were talking about with some of the other things in trading, if a lot of people are looking at something, you want to know, because anything that a lot of people look at, well, people trade off of that information. You want to know that. Part of the self-fulfilling prophecy of market movement is what people are doing based on what they think they know, which is why the market isn't always logical or reasonable, and why a lot of very logical people do very poorly at trading. In fact, one of my very, very good friends who used to own a trading club, and I used to attend this trading club all the time, and he's trained a lot of traders, tons and tons of traders, so he's got a lot of experience with it. And he used to say that in his experience, the people who made the worst traders were doctors, accountants, and engineers. And these people, of course, were always mystified as to why they had such a tough time with trading, because they're smart people, and they're very analytical people, and they're very detail-oriented people, and you know, they're some of the smartest people on the planet. So they just get so frustrated and cannot understand why they can do so well at some of these other quite demanding professions and not do well at trading. And his opinion was that, and this is part of his opinion, part of my commentary on that as well, is that the markets are not logical. They don't always just follow what's reasonable. And people in these professions tend to be rather reasonable people. Which, again, they assume that's a good thing. Well, I'm not here to say if it's good or bad. I think in general it is good, of course, in general. But the problem is the markets are not that way. Most people make decisions based on emotion. And so that's what happens in trading. Trading is a lot of people making decisions based on emotion, and also on misunderstandings and misguidance. And is that even a word, misguidance? I'm not sure. But that frustrates the heck out of a lot of people. And, you know, and then I remember going to one of my very first trading courses. Well, it was one of my first schools I went to for trading. It was an actual physical school that I attended. And it was one of the more advanced classes, though, in that school. And they had all the computers lined up. Everybody had their own trading station, and we're all trading away. And, you know, we're doing live trading. It was a day trading course. And there was this one guy who he didn't really seem to pay much attention in class. He stood out from everybody else. He was one of those guys, a real character, who just seemed to say whatever he felt like saying, regardless of what anybody thought. Not much respect for social convention, but he would come to class late and he would leave early. And so he'd miss even some of what was being taught. But he'd zoom in his little sport. He had a little sports car, and he'd zoom in. He'd listen to a little bit, and then he'd sit down in front of the computer, and he'd make a few $1,000, and he'd get up and leave. And he was a beginner. And you know, to the rest of us, including myself, it was just astounding. We were just like, what the heck? How does he do that? And, at first everybody was annoyed with him, including the teacher. And but after a few days of this, the teacher said, you know what? The guy's just a natural. He's just a natural trader. He's not restricted with all the mental baggage that all the rest of you guys have. He's not over analytical. The rest of you are so overly analytical, you get to analysis paralysis. He just comes in, he knows his rules, and he trades them. He doesn't care about much of anything. He's in, he's out, he's in, he's out. If something goes against him, he gets out. It doesn't bother him. It's no big woof. And if he, starts making money, he just hangs in there and watches the P&L climb and climb and climb and climb. He doesn't seem to have any emotional, filter that gets him too excited about making money. So he just lets it go until the thing runs out, and closes out his account, jumps in a sports car, and goes meets his girlfriend. But he said that's what good traders are like. They're not necessarily always the most intelligent people as far as that goes, but they just don't, they get out of their own way. In other words, they're not in their own way. They just do what needs to be done, and that's it. And unfortunately, that's not quite my personality style. I tend to be a little more analytical, so my learning curve was a lot longer than that gentleman's was. But I did eventually, in my own kind of contrived way of trial and error, and mostly error for years, figure out pretty much the same thing that guy figured out in like a day. And for me it took years. That trading, it's not really that complicated, and we overcomplicate it, and the more we try to make sense of it, it's just a fool's errand, because it doesn't really make a whole lot of sense, because it's mass psychology, as we talked about in course number 1, and the masses are not trading based on solid mathematical principles. They're trading on emotion. And so these charts, a lot of people believe indicators are the secret, or some kind of big ancient mathematical Phoenician formula or something, and nothing could be further from the truth. It's just a bunch of people putting in their bids and their offers, getting emotional, fear and greed. They get scared, they get greedy, and that's what's being plotted, and that's it. So the more you can just go with the flow on that and make it easy on yourself, the better trader you're going to be, basically. So anyway, having said all of that, let's get back to gaps. Gaps fit into that category because a lot of people look at gaps, and that's the masses. And so if the masses are looking at it and making some sort of decision off of it, then you should know what they're looking at. So basically there's 3 kinds of gaps, and again, this is not my invention, this is common wisdom, but I have a little bit that I add to it that's unique to myself, I believe. And so the 3, basically it goes with our trend analysis. Okay, we got a trend, and so the 3 types of gaps are a breakaway gap. And a breakaway gap, basically, by definition, just occurs early in a trend. And then you've got measuring gaps, and those occur in the middle of the trend, and sometimes they're called runaway gaps. And then you get your exhaustion gap, or gaps, and they occur at the end of a trend. So it's pretty much that simple. They're simply defined by where they occur in the trend. So generally, the breakaway gaps we like to see come out of some sort of consolidation period, where that's kind of where it gets its name. It breaks away from a sideways movement, and then all of a sudden the market goes boop. Yeah, we're going to open up here today. Now, measuring gaps, sometimes it's assumed that there's only one measuring gap, and I don't know if that's common or not, but for me in my house, measuring gaps, there can be a bunch of them. They're just gaps that affirm and confirm that this move is still strong. So you can have 2 1, 2, 3, 4 measuring gaps. There's no limit to how many you'll have. I've heard some people say, well, there's 3 types of gaps: the breakaway, the measuring, and the exhaustion. And so if you get a third gap, that's an exhaustion gap. Well, that I do not believe. I have seen markets, in fact we've got one in front of us right here, which is why I bring up this particular chart. This is a 30-minute chart of bonds. And you can get several gaps. And then the final one will be an exhaustion gap. And my favorite kind of exhaustion gap is an island reversal, where you get market coming up and then boom, you get some kind of bars up here, and then you get another gap down. So there's a gap going up and a gap going down, and that's an island reversal. You get a little island floating up here by itself. That's my favorite kind, but you don't see them very often. So that's one type of exhaustion gap. But an exhaustion gap is just simply the last gap of the trend. It's pretty much that simple. Okay, so let's look at a real chart now. So here you can see we've got all our moving averages clustered together, and that alone, just the fact that you've got your 15 period, your 50, your 100, your 200 period moving averages all clustered together like this means you have a contracted market. It means there's been no significant price movement or difference from 15 periods ago or 15 bars ago to 200 bars ago. The price is staying in around roughly that same range. Okay, so that is a very good clue that we're in a consolidating market. So here we get a little breakaway gap. Now this is scaling's kind of tough to see here. If I increase the scaling, it's a little easier to see, but this was such a big move that things went crazy. So okay, let's put in, because there's several different principles that all come in together here. Okay, so we get a gap from this green bar here to this red bar here. We get a little move up, and then boom, this high, which formed resistance, becomes support, and you have the 15 EMA as well. So this is actually a cluster of support. You'll find if you put your horizontal level off of this cycle high over here. So that's nice. We come back up again. The market has a little bit of a hard time. It comes toward this high, doesn't quite make it, starts retracing a little bit, and so then the next day, each one of these vertical lines is a new day, by the way, and gaps normally occur at the beginning of the day. So they happen overnight, which, by the way, is part of the risk of swing trading, is that you get these gaps overnight. Swing trading I define as any trading that holds the market overnight and is short of investing. So, you know, this can work for you or it can work against you. In these cases, it happens to be working for you. So that's a breakaway gap. Boom. And I would even consider this a breakaway gap. So you can get 2 breakaway gaps here. And the reason I consider this one a breakaway gap is because really the 50 MA has not started significantly angling up yet. We've just gone into another potential consolidation period, but basically the 50 MA is flat this whole time. And so therefore 1 breakaway, 2 breakaway. Okay. Then we start our real trend. So now here the 50 MA is clearly angling up, and we get another gap. So this is the 3rd day in a row that we get a gap on the open. Open, 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 and that's showing a lot of strength. Now what's interesting is during this time you see 50 MA is flat, and the other thing that is the problem is that your volume is still pretty low. We're getting a little bit of volume pumping up here, so this is encouraging, but OBV is not. We get a little bit more here, so this is just starting to show a little bit of volume support now before this next gap here. So this is the measuring gap, or the runaway gap. Now OBV moves up, volume histogram moves up, and now we've got everything in sync. Everything's lined up. We're rocking. Okay, let me reduce the scaling here again just so you can see the big picture all at once. And then we get another one. And again, that I would consider a measuring gap. Notice here, volume declines. Price does not retrace, but it consolidates, which is basically, I consider it still a type of retracement. That's your retracement, even though it's not going down. Retracements can go down where they can just consolidate. It's weighting. This, the fact that it's consolidating and going sideways, is actually a very bullish pattern. Volume declines, and boom, another big huge gap. Now, here comes a big question. How do we know that we've already had breakaway gaps, we've had, well, this one actually was a measuring gap here. So how do we know this one is not an exhaustion gap, in that we should take that short? Okay, the honest answer is we don't. It's like everything else in trading. You're not going to know until it's over. Hindsight's 20/20. So this is a major issue with retail traders. Retail trader meaning amateur trader, is their mindset is completely whacked. They are always asking, how do I know? Well, how will I know this? Or how do I know that it's going to do that? And that's actually two mistakes in one when you ask, how do I know that it's going to do this? So when anybody asks me, how do I know that it's going to do this, right away it puts up a signal for me, kind of a warning flag, saying, maybe the person just misspoke, but probably they are working under false assumptions. And the false assumptions are that you know anything in trading, because you don't, and that you can be certain of anything, because you don't. Those are the two false assumptions in that statement. How do I know? You don't. How do I know that it will? Means you're assuming that you can have some certainty, and you can't. It's all about probabilities, and it's about money management. You don't know anything, and nothing's certain. So, same with gaps here. We don't know that that's an exhaustion gap. There will be some clues that we can look for. Exhaustion gaps have certain characteristics we look for, but again, sometimes they work, sometimes they don't. And this is actually one of those, which is why I like this particular chart, because it points out, I like to point out problems. I like to point out when things don't really work that well. So this chart just gives us so many great things on gaps. So an exhaustion gap, generally what we want to see are volume spikes, major volume spikes. Well, we got major volume spikes here, don't we? I mean, look at the rest of this volume. This was puny, this is showing encouragement. This is just way the heck above the moving average. Way more than 50% above, way more than 100, that's like 200% more above. So that is, or that could be considered exhaustion volume for sure. And, you know, we've been in this trend for a little while. So this is one where you might actually say, I think that's an exhaustion gap, and try to take that short. And indeed, when you come down here, OBV even makes a lower low. So it looks pretty good. Problem is, it wasn't. It wasn't. And even this one is not. This one is not. This is still just a measuring gap. Okay, now again, here we get pretty good volume. That could be exhaustion volume. OBV moves up here, but that's beside the point. Come back down, we make a lower high, and look at this. We've got a triangle here. This could be, let me clean up my chart here. This could be a head and shoulders pattern, couldn't it? Higher high, lower high. Exhaustion gap on a head and shoulders, looking sweet. OBV on this second high is a little lower than on this high. Of course, and volume is coming down, which is great because this is the retest of this high, and we want to see less volume on the retest of this high. So honestly, this looks like a pretty darn good head and shoulders pattern, all things considered. Problem is, it doesn't work. And we go back up and we break this high, and if you took the trade, you'd be out some of your profits probably here at this low. So not a huge loser, but it's not a winner, and your analysis of it being a head and shoulders pattern was wrong. And honestly, this is even a trade that I might have taken. It looks pretty good to me. The one thing I don't like about it actually is the unbalanced volume pattern. This is not great, because remember, on these unbalanced volume reversal patterns, we like to see a much lower low. Remember I talked about that? I want it to be dramatically lower, and this is not dramatically lower at all. It's almost an equal high. So I want a dramatically lower high, I should say. The lows I'm not quite as concerned about, but the highs, and this high is almost equal to that one. So OBV, really this signal is not helping me, but the volume histogram looks good. The overall pattern looks good. We're late in the trend. That looks good. This could be an exhaustion gap. That looks good. We've got spike volumes here and here. That looks good. Everything looks pretty good, except OBV, but again, it's rare to get everything to line up. So it's all beautiful, except it doesn't work. And the trend keeps going, and we go into a mega trend, and that's what happens. So this is why money management is so important, because we'll go short wave 7 and 9, but you never know, you might go into a mega trend, and we are not going to go short anymore now, because these mega trends, Lord only knows how long they're going to go, and this one goes a long ways, which is exactly why we limit ourselves to 2 tries. Okay, so I just love showing this chart because it just shows so many great things that happen in real life, in real trading. This is not what most authors would put in their videos or their textbooks, because it doesn't work out the way they wanted it to. I want you to see this because I want you to know why money management is the key. The technicals don't always work out the way you think they're going to, and it's also an example of how all these volume patterns and everything are good for about a half cycle, and then you got to reanalyze everything. Okay, well that's it for this video. We're going to do another video on gaps, so let's move over to that one now.